US Federal Reserve. He did oversee 3 quantitative easing programs, and for the first time, he's opened up on the 2008 financial crisis in his new memoir, The Courage to Act. CNBC's Squawk Box team spoke exclusively to Ben Bernanke on the 2008 crisis and its aftermath.
The low growth is coming not from the recession per se. I mean, we've come back quite a bit. Unemployment's down to 5%. So we've come pretty close to full employment. The slow growth is coming from slow productivity growth. You know, output per worker has not been growing quickly. And why that's happening is not totally understood. I don't think it has much to do with monetary policy. It has to do with the waves of innovation. We saw slowing in productivity growth even before the crisis. So I think that's part of it. But clearly, one of the issues is that we've been relying too much on the Fed. The Fed has been the only game in town. It's been doing most of the policy heavy lifting for the last few years. We need to see more action from other policymakers.
But when you think about 6 years of 0%, wouldn't you have expected at some point in time that there would have been this pop, that we wouldn't be doing what we did, for example, in the first quarter, 0.6% growth, and concerns almost every quarter that we're going back into recession?
Well, in a slow growth, low real return economy, not just in the U.S., but everywhere, and compare the United States with Europe, compare us with Japan, other industrial countries, we've been making more progress. I'm not saying things are great. I don't mean to say that at all. But monetary policy can only do basically 2 things. It can keep inflation low and stable, and can help the economy come back from recession. And both of those things are happening. More growth, it's got to come from productivity. It's got to come from capital investment. Those things need some help from other policymakers.
Let's talk about...
Just very quickly, a follow-up on that. Is that a suggestion that this is kind of the new normal, that it's going to be very difficult to fix these things?
Well, if you look around the world, it's not just the United States. Real interest rates are low every place, and we've got, you know, what I used to call the global savings glut. There's a lot of savings looking for return. There's not that much, you know, in terms of really high return investments available. I think that's not Fed policy. I think that's just where the world is right now.
Could be QE over there, too, though.
Well, if it were true, if there were lots of high return investments available, then you're seeing more capital investment than you're seeing. So I don't think it can be QE, no.
Let's talk about where the Fed is right now. There's been a lot of talk about this is the year that interest rates would rise, and along comes a jobs report like last week, 143,000, much less than expected, downward revisions to the prior 2 months. How would you, as a policymaker, have processed that report?
Well, you know, the Fed's plan to raise interest rates depends both on continued progress in the labor market and also inflation moving up to target, which it also depends on progress in the labor market, because reducing slack, creating pressure on wages and prices is, you know, the source of inflation in their thinking. So the bad numbers or mediocre job numbers last couple of months certainly is a negative for that plan, no question.
Mr. Chairman, people know you as a very great public servant and very, very humble. And I read that headline on the op-ed of the Wall Street Journal this morning, how the Fed saved the world. And it was so uncharacteristically you that I was never a print reporter, but the editor came up with that, right?
Right. Now, your viewers should know that not only does the op-ed writer not have a chance to write the headline, but I couldn't even find out what the headline was until it appeared in the paper.
What was your response when you saw it?
Well, my response was, this is not what I wrote about. What I wrote about was that the Fed has done what it can. Things are not great, but the Fed can't be expected to solve all problems. It's time for other policymakers to join in.
I'd hate to be quoted on that in the future as you, saying that, because you remember the cover of the magazine. Well, the committee that saved the world was Reuben Greenspan.
What can I do about it? I mean, but again...
Write a letter to the editor.
And you can go on the record here saying that...
It wasn't my headline. It wasn't my intent.
I want to ask about current policy. There's a debate out there, and I want to know where you come down. Some people say, as you just pointed out, they've not hit their inflation target. We're in a low-growth environment. We need 0% interest rates. That's what the market would set, even by itself, or something close to that. The other one says, you know, how can you argue 5.1% unemployment, 2% growth, that there's no rationale at all for emergency-level interest rates such as you set in the most dire moments of the financial crisis? Where do you come down in that debate?
Well, I would just point to the inflation rate. You know, even if the Fed had no interest whatsoever in growth and employment, which of course it does, but it has a 2% inflation target. It needs to get inflation up to that target. And, you know, easy money is justified by the need to get inflation up to the target.
Was growth good in the 50s and 60s with inflation under 2%? I mean, how can we possibly know what an optimal inflation rate is?
Well, we know that...
What was it in the 50s and 60s?
It was low. It was obviously low.
And we had great, robust growth.
Yes, but there are many factors involved. And, you know, you're probably going to tell me next that deflation happened in the 1870s, too, which is also true.
I just wonder if we actually know.
Well, we do know in a world where there's low demand and low real returns, the risk happens that, you know, if inflation is so very, very low that it's close to deflation, the risk is that ordinary interest rates will be low all the time. With very low inflation, ordinary interest rates will be very low. What happens when there's a recession? There's no place to cut. That's part of the problem.
Now you're making the argument a lot of other people make about where we are.
Should have raised it in order to have some ammunition to cut.
No, that doesn't make any sense. If you raise rates too early and you kill the economy, that doesn't help you.
But the flip side, and we were talking about this morning with Trian making an investment in GE and suggesting, for example, that they borrow some more money so that they can do more buybacks. You look at that, what's going on in corporate America. Has the policy itself perverted the way businesses act?
No, I don't think so. It's low return economy, low return, low cost of capital. There's not as much capital investment as we like, but you've seen housing coming back. You've seen autos being very strong. You've seen the economy using up slack. You know, I mean, compare us to Europe, where they didn't do QE. And there's a big difference in unemployment.
The people say that corporations, at this point, the reason they're not making capital investments is because they're able to buy back their stock at low rates and reduce the outstanding shares. Earnings per share goes up. They're compensated on stock prices going up. So instead of doing the long-term things like hiring and capital investment, that they're financially engineering results because of ZIRP. And then they also say they're doing mergers and acquisitions where when you cut employment and you cut manufacturing, you're not expanding plants and things that. So all these things end up being a misallocation of where capital would normally go. And that could be part of the problem of why we're not growing.
No, I don't think so. There's no reason, if you can do mergers and acquisitions, and you can also do capital investment, there's no reason why they're, you know, mutually exclusive. And it looks to me that, again, you look across the whole range of interest-sensitive spending, including capital investment, equipment, and research and development, by the way, which has come back very strong. You look also at autos and houses and other interest-sensitive spending, and it's been enough to help bring us back to 5% unemployment.
Ben, I want to ask a question about the critics. They appear repeatedly in your book. They're the antagonists. There's not a single person. And you talk about the crisis giving rise to certain extremism in the political system. When you look back and think about how you handled the critics, are there things that you would have done differently? Well,
I mean, I did my best to make my case. That's really all I can do. I think the one thing that as I go back and think about what we did during the crisis, we were so engaged in trying to deal with the weekend emergencies and the chaos in the markets and in the economy. I don't think we did as much as we could have. We did a lot, but we didn't do as much as we could have to explain to the public what we were doing and why we were doing it. You know, and I went on 60 Minutes. I did a bunch of things to try to explain what we were doing, but still out there was a lot of view that, oh, the Fed is just helping Wall Street. They're not helping us, and so on. And I think if we had done more of that, maybe some of that criticism would have been diffused.